Brian, can you explain asset purchases and stock purchases, as well as the implications for the two in terms of insurance?
Yeah, so basically, when you think about a business, when you buy a share in a company, you're a stockholder in the company. So you're buying shares of the business. When you just buy the assets, essentially the business essentially gets dissolved. You're buying the actual assets for cash. The liabilities then would still be part of the prior business's problem. But when we actually acquire a company and it merges into ours, or we take it over as a shareholder, we assume the liabilities and balance sheet issues in the business, which could even be tax issues. So it's important, from an operational perspective, that you understand what you're getting yourself into, number one. And number two, insurance is a critical part of that. When you actually buy a business, you're typically buying, let's say it is the assets, you might still be assuming things like what their workers' compensation history was. That might be something that transfers over because the employees might transfer over. So that might be something you automatically have to realize is still part of the deal. The second part of it is if you are buying that business and it has a liability policy in place, and you're assuming that liability policy, you might have to rewrite it for you as the new owners. And that could change the terms. But also, you need to be aware of what was actually happening in that business before you took over. A lot of times there's prior liabilities and prior things that come out of the woodwork 5, 10, 20 years down the road. And if you don't have all the prior insurance policy information in the files of the business you purchased, that can be a big issue for you because you might find that you can't figure out if there was coverage for it. And if there was coverage for it, you wouldn't know where to go.